4-1 advancing to declining stocks. That's not enormous given the big declines we've seen, but it's a gain. Take a look at the sectors. Nice to see the retailers up, and I don't mean just Amazon. The JCPenney's department stores, they're up 2 to 4%. Energy's rallying. Oil's up $1.80. Tech's modest contributor too. Banks flattish again. That's the one big disappointment here. And consumer staples contributing a little bit. Utilities, slightly more defensive groups, not quite as much. If you look at the FANG stocks, we've got a nice rally there. Amazon's rallying nicely, and Amazon's one of the few big names that are up this year. It's up about 20%. Netflix is up about 20% too. It's rallying nicely, but all of the big FANG names are to the upside. We've talked about how dramatically oversold things are. I don't want to put up any silly numbers, but there are pretty extreme numbers. I talked about this on Friday, that the market's discounting a very bad 2019. So let's assume instead of 8 to 10% earnings growth, which is what the analysts have right now, let's assume no earnings growth for 2019. The number is 162 for the S&P 500. What's the right multiple? We've had, let's say, instead of 15 to 17 as the multiple for the last few years on an expansion, let's say slight contraction in the economy. Go to 14 and a half. Do the numbers here, 162 times 14 and a half. You get where we are. 2350 is right where we are. My point is the market has discounted a pretty rotten 2019 with no earnings growth and a deceleration in the economy. That's a lot to deal with right now. So what's out there, the big three issues that we keep trying to talk about? The Fed and rate hikes. It seems to me the Fed is definitely signaling they're going to be more dovish. I think that's going to come, and you're going to see that more obviously in the next couple of months. On the tariff talks, it's still uncertain, but they're going to restart in January. Both countries have seen some economic weakness. I can't help but think there's going to be some momentum to come to some kind of deal, maybe not on the long-term technology issues, but at least on the tariffs. On earnings, forget 8 to 10%. We're talking about 0 to 4%. There's some numbers out there, but it's low single now rather than high single numbers. The one thing that's a little tougher is the political risk. Mattis leaving does definitely raise the stakes and throws in another little X factor there. So here's the question to ask, the right question, I think. How much is really discounted for a recession? Let's go to like extremes. Nobody's even looking at recession. But say, look what we've got here now. S&P 500 is down 18%. What's an average decline in a recession? Well, the median, 50% more, 50% less, is about 25% for recessions. In 2008, we had a much bigger decline, more than 40%, but that was unusual. The median decline for stocks in a recession is about 25%. Well, look how far we've already come. Already, analysts are out noting this fact. Mike over at MKM this morning, Mike Darda, had this exact comment. He said an 18.5% drop suggests that the market seems to have already discounted the bulk of a recessionary outcome. We would recommend upping risk exposure. Now, that's Mike, and I think you're going to see a lot more of that. The point is, we're already dramatically along the way to discounting a recession, and nobody's even calling for a recession in 2019. Little wonder here, and nobody knows if there's a bottom here. We all know you can get extreme numbers even beyond here. But in terms of the fundamentals, which is what I like to look at, we certainly look like we're at some kind of bottom and some kind of discounting for a pretty mediocre 2019. Right now, we're at the highs of the day, up 232.